Chinese stocks have been absolutely crushed recently. The Hang Seng China Enterprises Index, for example, is down 43% from its 2021 high. And as this Bloomberg chart shows, Chinese stocks listed in Hong Kong actually had their worst day since the global financial crisis 2008. It seems like generally stock declines are much more rapid nowadays, as only a year ago Chinese stocks were enjoying an unprecedented boom. The Chinese KraneShares CSI China Index, for instance, which covers Chinese internet-related businesses, reached an all-time high of $102 just 1 year ago. And fast forward to today, and the KWEB index got absolutely crushed. At one point it was down 79% from its all-time high. In fact, the KWEB was at one point trading 20% below the price it was trading at, or trading for, at the index's inception date back in 2013. 2013, that's 8.5 years ago. Obviously, such a decline in a broad market index is almost unprecedented, and was basically only seen in the Nasdaq's 78% peak-to-trough decline during the dot-com bust, which took 31 months, by the way. The KWEB's 80% stock decline, on the other hand, occurred in just 13 months. So the question investors need to ask themselves here, obviously, is whether this massive sell-off offers opportunities, or whether investors need to stay clear of Chinese stocks due to the risks associated with Chinese investments. So without further ado, let's discuss these questions. Alright, hello fellow intelligent investors, my name is René Zellman, and I have actually covered some Chinese stocks on this YouTube channel in the past. In particular, I made a couple of videos on Alibaba's stock. And just like broad Chinese stock indices are down big time, individual stocks like Alibaba, but also Pinduoduo or Tencent, also suffered unprecedented losses over the last couple of months, or more specifically the last year. At one point last week, Alibaba was trading for $74, so lower than Alibaba's IPO price back in 2014, which was $90 a share. Now, I think these steep price declines should catch every investor's attention. And obviously it bears the question of what has actually caused this development, what has caused these price declines. How and why did Chinese stocks go from being investors' favorite stocks to no one in the world wanting to invest or to touch anything related to China? I mean, basically over the last few weeks we've seen a full-blown panic. Just the other day, for example, the investment bank JP Morgan downgraded Alibaba and 28 other Chinese stocks, and they called Chinese internet stocks, quote, uninvestable, at least for the foreseeable future. They wrote, a large number of global investors are in the process of reducing exposure to the China internet sector, leading to significant fund outflows from the sector. And similarly, the US Securities and Exchange Commission said last week that US listed securities for 5 Chinese companies are actually at risk of delisting. Now, I think there are 3 main concerns with Chinese equities. First off, there's China's continued zero COVID policy, and due to the number of COVID cases going up quite recently in some Chinese regions, the Chinese health authorities have ordered new pandemic-related shutdowns in Shenzhen in particular. And of course, this affects the people living in the city, but of course also investors who are worried about the impact of these lockdowns on the already quite fragile supply chains, which would make global imports and exports of crucial goods more difficult. Now, on top of that, the geopolitical tensions and the tragic war we are seeing in Ukraine right now may be seen as another main concern. First of all, investors are worried about Beijing's close relationship with Russia. China basically refused to impose sanctions on Russia, and the US has already publicly threatened to sanction China itself if they should decide to help Russia evade sanctions, if they help them militarily in any way. So I think the risk of a united West hardening its attitude toward China is certainly, or has certainly increased over the last couple of weeks. Moreover, I think the united and coordinated response of the West towards Russia's aggression and the subsequent bloodbath of Russian stocks and Russian ADRs in particular might have again highlighted the risks that come with investments in generally authoritarian countries and states, of course. The destruction of market value in the Russian banking, oil and gas industries in particular is almost unheard of. Multi-billion-dollar companies are now basically worth nothing, only pennies. For example, Russia's largest bank, Spier, crashed from $14 a share in February to just a few cents in early March, basically a decline in market cap of 99%. And then thirdly, investors are of course also still worried about the possibility of US listed Chinese stocks being kicked off US exchanges. As I've said before, the SEC actually named 5 Chinese companies last week that could be subject to delisting if they fail to comply with certain auditing requirements. Moreover, most of you are probably familiar with the issue of VIE structures, so variable interest entities. Basically, by buying Chinese ADR shares, you invest in a Cayman Island shell company, and via a complex legal agreement, you basically have a claim on the assets of the China mainland company and the profits it makes. And the concern here is not new. Essentially, this structure looks to be quite vulnerable and easy to attack should Chinese authorities ever want to do this. And this tweet here actually summarizes the issue quite nicely. And here, obviously, the war in Ukraine and the reaction of the West in a way highlighted that risk once again. It seems like most investors have just capitulated by now and came to the conclusion that Chinese ADRs are basically worthless paper. And quite frankly, I'm more aware of that risk than ever. I have no idea what would happen to these ADR shares if, for example, China were to invade Taiwan, for instance, and the West would sanction China. And to be very clear, I think you need to be aware of that risk, even though the risk itself may already be, quote, priced in. Now, let us quickly untangle these concerns. I think some of the concerns refer to the actual business fundamentals of these Chinese companies, and some of the concerns are actually not related to the businesses themselves. Let's start with the concerns regarding business fundamentals. Here, the recent lockdowns and the surge in COVID cases, of course, need to be mentioned, but also the regulatory crackdown on big tech. So, first off, if China locks more of its cities down again, that is a problem, obviously. But these lockdowns and subsequent supply chain issues will eventually be resolved, and keep in mind that a company's profits over 1, 2 or 3 quarters represents only a tiny fraction of the cash flows the company will produce over its lifespan, and thus the intrinsic value of Chinese stocks will actually not be meaningfully impacted by these temporary shutdowns. Then secondly, the crackdown on tech companies of course also affects business fundamentals. For instance, antitrust investigations, antitrust fines, and obviously actions like abolishing business practices like the choose one from two strategy in the commerce space. Of course, this weakens the position of individual companies. However, what did not get a lot of media attention is the fact that the Chinese Anti-Monopoly Enforcement Authority actually recently published an article in which they stated that the platform economy had improved considerably in terms of pricing, competition, fairness, and safety. So in a way, they are indicating that their goals were achieved and that China's crackdown on big tech may have come to an end. Now, the other concern is related to the nature of Chinese ADR shares and VIE structures. We've just talked about this. But what the media also rarely reports is that China has on multiple occasions actually indicated that they are willing to work on the issues, work together with the SEC and try their best to resolve the auditing and delisting concerns. On March 11th, for example, Reuters reported that Chinese and US securities regulators are expected to reach a consensus soon. And actually, while I was planning this video, we got some even better major news. And Chinese stocks have actually surged 20 to 40% or even more last Wednesday. The KWEB itself was up 30%. Again, this is a major index, and I think those are just truly incredible market movements. Liu He, who is known to be Xi Jinping's right-hand man and main economic advisor, is actually quoted saying, "The Chinese government continues to support various kinds of businesses overseas listings." The China Securities Regulatory Commission said in a statement that they believe that through joint effort, both sides will, as soon as possible, be able to make arrangements for cooperation in line with the two countries' legal and regulatory requirements. And China economist Larry Hu said, China's top leaders finally broke the silence to respond to the recent market sell-off. The tone of the meeting is strong, suggesting that policymakers are deeply concerned about the recent market rout. Now, just to be clear here, nothing is written in stone yet, and similar signals were actually sent many months ago by Chinese regulators. Just take a look at my videos on Alibaba. But nonetheless, I think this is a rather positive sign. And if you take a look at my Alibaba videos, in these videos I've actually also highlighted that I think China still relies on Western capital, so I think an actual written agreement is actually fairly likely. An investor who I really look up to, Seng, he has actually tweeted in early January, when the KWEB index was still trading in the mid-$30 US range, that he thinks the KWEB index actually looks quite attractive. Let me quote him here. "I told a family office this morning that they should consider KWEB. We don't do mega cap tech, but I think it's a good risk reward on a 3-year view. It's down 75%. My guess is that most Western investors view the ADRs as worthless paper. In my opinion, it's all psychology. We'll see." But on the other hand, the risks I outlined in this video are actually a real concern. But every investment carries some risk. And this idea that every investment carries risk was actually beautifully summarized by another legendary investor, Spier. Here's what he said. "All private property is potentially subject to state appropriation in one way or another, via taxes, nationalization, or eminent domain. And when you own common stock in a company, the ownership can be appropriated through excessive share issuance and various other methods. So at the end of the day, no matter where the company is based, the devil is in the details. Each case is different, and it's our job to study each particular situation and come to a conclusion based on all the factors." And again, if you want to learn more about Alibaba specifically, keep in mind that the stock is actually down some 70% from its all-time high. You should not miss the following video in which I have discussed, the business fundamentals.